Hi there. This is Greg Stewart at Topturn Capital, and welcome to this special market comment. Well, we've seen quite an increase in volatility in the financial markets over the past few weeks and months. In fact, I don't know that we've seen volatility like this for probably almost 2 years. There's been a steady diet of pretty pessimistic news flow, everything from high inflation to rising interest rates, as well as the Russian invasion of Ukraine. These things, as they come together, have put investors in a pretty pessimistic mood. I'd like to give you 3 quick insights that might help put things into perspective, maybe soothe a little bit of nerves, as well as give you confidence moving forward. All right, let's look at a couple of slides to illustrate these insights. So first, this is a price chart of the S&P 500 index over the last year or so. And you can see that after a nice run in 2021, that the market peaked and has started a little bit of a pullback phase. Sometimes as investors, we get a little too focused in on the short term, and we take the most recent results and we extrapolate those out. And that can cause us either a little too much optimism or a little too much pessimism. But when we do that, we lack the perspective of the longer term. The second slide here is a much longer term chart of the S&P 500 index. And you can see that over the last 13 years, the market's been in a decent uptrend. Investors made a lot of money in the US stock market over this time period, but it's never been a straight line. You can see that there's rallies and pullbacks and corrections, and those happen from month to month and year to year. And that's just normal part of equity investing. As I mentioned, stock market corrections are pretty normal. You can see that they happen often over the course of a year or over the course of a couple of years even. The correction we're in now probably is in that moderate range on the S&P 500. And so typically we have one of those a little more often than once a year. And it's probably been a good 2 years since we've really seen a good pullback in the market. So again, the first insight here is take a step back and have a much broader perspective and a little longer term perspective. And that will help you navigate when markets get a little choppy. We're big believers in having a tactical component in every portfolio. The reason for that is, as conditions in capital markets change, this piece is designed to shift investments around, either increasing investment risk or reducing investment risk based upon the prevailing environment. Why that's important is that over the past 3 or 4 months, our clients have noticed that we've been in reduction mode of risk. We've been selling off stocks and bonds and increasing our allocation to cash. So the second insight here, more than anything, is that it's important to have some piece of your portfolio be responsive to the things that are going on in the capital markets. And the second part of that is that we've been able to build up quite a bit of cushion by having a large position in cash as the markets have gone down. Finally, so you might be asking, where do we go from here? Well, let's start by talking just for a minute about Russia invading Ukraine. So that's got a lot of negative press lately, and the volatility in the markets has picked up quite a bit. However, as we look at it in the context of how has the market done in prior experience with wartime events, and that's what this chart is showing here, is number one, the median loss is a mere 2.2%. And then interestingly enough is after this initial reaction date loss, the markets have typically on average been up over 3 weeks to 2 months to 6 months to a year. And you can see that across the bottom here. Part of why that happens is that a lot of the downward pressure happens kind of in anticipation of what may happen with global conflicts. And I think that's the case here, is that we've had some negative returns going into the conflict, but now we've had a nice little bounce here. I think the bigger worries in the market really have been around what the Federal Reserve may or may not do with interest rates. And this chart that you're looking at now really kind of lays out what happens at the first rate hike date. And that's that first dashed line on the left going from top to bottom there. And typically markets have been weak after that first interest rate hike, sometimes really weak based upon whether or not it's going to be a fast tightening cycle, or actually initially weak, but actually fairly strong 1 year out if it's a slow tightening cycle. Now, the big worry when the Federal Reserve starts to raise interest rates is will this lead to some kind of slowdown or even recession? And that's really where most of the damage is done in equity investments is once we get to recession. That really is where the damage is done. And I think it's unclear at this point that the Federal Reserve is on a path that's going to lead us to a recession. In fact, you could probably argue that the global conflict in Ukraine may actually temper the hand of the Federal Reserve as to not tighten too quickly while there's this global disruption going on. Finally, emotion has a huge impact on investor sentiment, especially in the short term, which interestingly enough has an impact on what the future short-term results would be. This chart here depicts investor optimism. That middle clip is a measurement of the market participants and whether there's a lot of optimism or there's a lot of negativity or pessimism. Interestingly enough, when the number of people that are optimistic is very, very low, that's led to actually outsized gains in the market. And you can see this in the bottom left corner in the table, is that when there's a high level of pessimism or extreme pessimism, that's actually led to 29% annualized returns since 1994. And when there's a high level of optimism, you can see the returns have been actually negative to the tune of almost 7% annualized. So this leads to the last of these insights that I wish to share today. And that is things such as a war in Ukraine and interest rates rising has actually led to an environment where we have a lot of pessimism out there. And that at some point will be a very positive thing as it leads to future returns. Sentiment and emotion is a strong thing. And you just have to learn to actually be kind of opposite of what your emotions are trying to tell you to do. Well, I hope these three insights have given you a broader perspective of how to approach this current environment that we're in. Should you have any follow-up questions, please reach out to a member of the Topturn team and we'd be glad to get those answered for you. Otherwise, I wish you a great day and until next time.